everyone, and welcome to our knowledge transfer session. Today we're going to be talking about a kind of a funner topic than normal. We're going to talk about how you double your money. Take $100, grow it to $200, and just some of the basic principles around that when we talk about investing. So we're going to be doing a lot of rules of thumb today. And when we talk about rules of thumb, just recognize that this information can't all be guaranteed. When you invest money, there's always this element of risk. And so we have to treat today's presentation as general in nature, but we're going to try and give you some good principles today about how you double your money when we talk about investing. Now, my name's John Erickson. I have over 17 years experience in the financial services industry. I've worked everywhere from a bank to running my own practice. I'm here in Bellevue, Washington, next to Overlake Hospital. I'm a graduate of Washington State University, and I really love creating these videos for people to try and spread the knowledge I've accumulated over my career to you. And when we talk about doubling your money, this one actually spoke to me, creating this topic, because all the time I've seen clients, friends show me marketing things they see on TikTok or YouTube like this, talking about doubling someone's money. And there's a really strong emotional feeling around the concept of doubling your money. But I always felt there was something being left unsaid around risk, around, what you could actually just do yourself easily, without hiring someone. And so, I was like, well, let's create a video about how you double your money investing, because it happens all the time. And when we talk about doubling your money, when we talk about investing, we have to talk about the concept of gambling first. I remember I was at Washington State University, in fact. I was taking a class on personal finance, and the professor at the time was like, gambling is not the same as investing, and investing is not the same as gambling. There is a clear difference. And there is a clear difference. When you invest money, you have a general expectation that you'll succeed. But mathematically, when we're talking about gambling, the casino has the expectation of winning, not you. And when we talk about gambling, there's like this high risk and high reward concept where you can actually take money and win and win and win and win, and you can create great wealth like instantly. But the opposite of that is, you choose wrongly, you lose everything right there on the spot, because there's an element of chance there. And so when we talk about gambling, right, you don't have a reasonable basis that you're going to win. You could win, but you don't necessarily have a reasonable basis. But when we talk about investing, you should have a reasonable basis. You can win. You should have, you should be able to put your skill into investing to actually increase your odds of winning. On top of that reasonable basis, you're going to win. The idea that you're going to lose all your money while investing, which can happen, isn't necessarily realistic in most situations. And when we're talking about investing, over the long term, you should win. With gambling, over the long term, you should lose. And so, when we talk about when are you gambling when investing? Because you can actually gamble with your investments. Probably the easiest way to explain it is when you have what's called poor informational control. Meaning, when I go look at the history of Microsoft as a stock, and I can look at what their company's doing right now. I can look at their historical rates of return. I can actually get a fairly decent rate of return concept over say the S&P 500. Whereas gambling, you actually can't have that informational control. Sometimes you invest in something where you can lose everything right there on the spot. Accredited investors run into this problem all the time where they get offered investments that look really good, and then they can fail underneath them. And with investing, you can actually invest in something that you have a reasonable chance that you could lose everything. When we talk about investing, when it looks like gambling most of the time is when you're expecting short-term big gains, right? When you're expecting to double your money in a very short period of time, that typically is more gambling than investing. And when we talk about where is gambling versus investing, kind of one of those other kind of crossing patterns. If you're not getting ownership of an asset, if you're doing some type of derivative or something of that nature, you're starting to gamble more than invest, oftentimes. Now, we run this problem when we talk about investing, where sometimes people feel like it's gambling. And there is a difference between an investment looking like a gamble and actually feeling like a gamble. And I run this all the time, because there's a lot of people who are really afraid of market risk. And one of the things they say is that their investments will go to zero, like a standard mutual fund, like an S&P 500 fund. You can definitely lose money on an S&P 500 fund, but the odds of it actually going to zero, the odds of it, totally failing, are probably infinitesimally low. But the feeling you feel in your heart looking at an investment like the S&P 500 can make it feel like it can go to zero. And you can actually assume that you're going to lose on an investment on something that over the long term has a reasonable basis of actually making significant returns. And so one of this problem we talk about investing versus gambling is the feeling problem. It's not a math thing you're doing. It's I feel like this is going to fail. I feel like this is a gamble. And the math doesn't actually support that. So when we talk about doubling your money, we talked about gambling versus investing, some of the basic principles. Well, sometimes you just make good decisions. Investments can double in a very reasonable short period of time. Look at Tesla, Nvidia, or Carnival. Right? In 2023, all three of these stocks doubled. If you put your money in any of these stocks in 2023 at the beginning of the year, you would have had this rate of return at the end of the year, and you would have tripled your money in the case of Nvidia, basically, right? So when we talk about doubling your money, when we talk about investing, it does happen all the time. It may not happen in your case, but it does actually happen reasonably all the time, if you can guess it, right? And the problem when we talk about investing and doubling your money is timing really matters, right? If you invest into each of these companies starting in 2022, you would have had significant losses. And part of its story about its doubling is knowing the timing of when to invest in it, picking the right thing that did actually go up or fix itself, and double from that low. And the problem with talking about investing and doubling your money is unless you're really good, and I'm not this good, and I would argue that most people who watch these videos aren't this good, unless you're really good, you can't time this correctly. And so you can always choose something that you think will go up in value. But when I talk about retirees, when I talk about investing someone's money, a lot of money for someone, the idea that you're going to buy a single stock like this and take this risk, you might do this during your working years when you have a lot of time to recover, but you're probably not going to be doing what you're seeing on the screen right here in retirement. You're going to probably spread out your risk because you just can't take the risk here that you put your money in something like Tesla that did double in 2023, but in 2022 it took a 65% loss. And if you time that incorrectly, that can materially hurt you and it starts to look like gambling. And so this actually brings us to the problem of what happens when you start to diversify your investments. And this is where rates of return matter because, remember, the idea of doubling your money can be very emotional. That's an emotional thing we all can understand. It's mathematical. It's important to actually have happen. But just the idea of doubling your money can be a very strong emotion. Fear of missing out is one of the common problems we run into around it. Rates of return matter. Rates of return say how fast your money will double. Sometimes you can just buy a home. Like your home probably will double in value over your lifetime or even higher than that. But if we're talking about investing, it's all about a rate of return over a period of time. And when I see a rate of return attached to investment, I generally know how fast it's going to double. I generally know how risky it is. It tells me a lot about an investment when I can attach a rate of return to this. So I would submit to you that the idea that your money will double in 7 years is not impressive. It's impressive as you can get to a rate of return because that tells you exactly how fast your money will double. So when you see these rates of return, can you guess the investment? 0.5%, 4%, 5%, 18%, 20.5%. Now, this is an investment in at this period in time. We're talking 2024 in October. This, of course, will change over time. But when you look at this, these are reasonable rates of return at this point in time for each of these different investments. And each of these different investments will double in a certain amount of time. And so while you can't guarantee this, there's a reasonable basis to say that this will occur. And so when you invest in a fixed annuity or CD, you'd expect to make around 0.5% or 5%. Your savings account, probably 0.5%. If you're by the S&P 500, if we look at the last 10 years, you're talking 12%. If you're talking a single stock and you pick correctly, you might be talking 25%, right? There's risk attached to each of these rates of return. Remember where I showed you Nvidia where it went up 200%, but it lost 50% in 1 year, right? There's these swings you have to be able to stomach, but once you diversify, you're going to typically take lesser returns, but also potentially lesser risk, and your money will still double. So when we talk about how long did it take for your money to double when you buy these standard investments that are generally fairly well diversified, you're going to see it can double actually very quickly. We talk about 5% fixed CD. It'll double in about 14 years. That's pretty good. I like that. If we're talking just a balanced index fund, doubles in roughly 9 years based upon recency bias. S&P 500, 6 years. A growth tilt based upon tech, about 4 years. Microsoft alone, 3 years. So there's a reasonable basis if you invest in something and you pick right or you diversify appropriately, your money will double. Okay, and it will double oftentimes quicker than you expect or even realize. You can't guarantee this because timing matters, but this gives you a good level set, because if someone tells you that I'm going to take your money and I'm going to double it in 15 years, well, once you know this math right here, you're like, well, that's not impressive. I can actually double it myself in 14 by doing no work and buying a fixed product. I can double it in 9 years with maybe less risk than you're giving right now. I can take reasonable risk and double it in 4 years. Why should I buy this thing that's doubling my money in 15? And so, if you can understand this kind of juxtapose between rates of return and how long it takes to double your money, you can actually understand, you can be better armed as a consumer about the decisions you make. And I understand this math very implicitly. I deal with retirees all the time, and I'm always trying to figure out, which portions of my money am I trying to double, but I know I'm taking risk there. So then where do I need to take money or less risk on the table? And I know I'm going to double the money less fast. It's a kind of a give and take I have to choose for my clients. So when you kind of go with this idea of doubling your money, a reasonable way to do it. Doubling your money is not guaranteed, but even doing something like an S&P 500 fund, you should expect to double your money somewhere between 7 and 10 years. And that's, you can buy that on your phone right now while watching this video. So it's very reasonable to expect your money to double. Not guaranteed, but very reasonable. If you expect a short-term doubling of your money, you're either a really good investor who's making good decisions, or you're gambling. I find most people, when I look behind the scenes, are actually gambling. They didn't have a good informational control to double their money. And there's always this annoying situation where someone doubled their money with one stock pick, and they talk about that. And then you look at their accounts, and you're like, oh, well, what about those other 9? And they're like, do not look behind this curtain. So I always think of it in my mind, it's like the Wizard of Oz who's yelling at Dorothy, do not look behind this curtain. Because the average person is not doubling their money like, say, the S&P 500, because what happens is you choose the one good thing, you choose some poor ones, and then you have a whole bunch of money on the side that you're not doing anything with because you don't know what decision to make, right? Because you don't want to put all your eggs in one basket. I'm an advisor. I should reasonably be able to tell you rates of return, how fast your money will double. I can't guarantee it, but I should be able to tell it to you in those simple terms. I tell my clients all the time, okay, this should double your money in around this period of time. Can't guarantee it, but this is a reasonable basis. You should do it, and you should hold me to that, and we should review it and see, did this occur? If someone says they can double your money in 10 years, that's really good, but not actually impressive. I showed you earlier that if you put it in the S&P 500, you should reasonably be able to double your money in 6 to 10 years. What's impressive to me is I doubled my money in 10 years, and I took a very low risk while doing it. Or I navigated this tough financial circumstances. There's lots of impressive situations where someone doubles their money in 10 years. But just the concept, if someone's coming to sell you something and they say they're going to double your money in 10 years, well, you can already do that yourself, paying no fees on your phone by the S&P 500 if it repeats what's done in the past. And always remember, the faster you go, the riskier it is. It just goes hand in hand. When we talk about doubling your money, when you see something that says it's going to give you really good returns in a short period of time and it's beating, say, the S&P 500, there's probably risk you're taking that you don't understand, that you have to dive into. So I hope that was helpful. I'm here to help. I once again have 17 years of experience in the financial services industry. If you want to talk to someone who wants to have a personal relationship with their clients, that's where I fit in the financial services world. So you're always welcome to reach out to me. I work with my clients either virtually or in my office here in Bellevue, Washington. But I hope this information was good about the concept of doubling your money in the financial services industry. And I hope you got at least one good piece of information today. Thank you.